8 million Americans lost their jobs. 10 million lost their homes. $22 trillion in household wealth evaporated. And the men who designed the machine that caused all of it received government money to keep their businesses alive, paid themselves bonuses with it, and returned to their offices on Monday morning. Not one senior Wall Street executive went to prison. This is not a story about greed. Greed is too simple. This is a story about a system so precisely engineered that it converted human misery into profit, operated in full view of regulators who were watching, passed through legal structures that made crime look like business, and when it collapsed, transferred the cost to the people it had already destroyed. The documents exist. The emails exist. The congressional testimony exists. The mechanisms are not hidden. They were just never explained to the people who paid for them. What you are about to hear is not a theory. It is a sequence of events with named people, named institutions, named decisions, and documented outcomes. By the end of this video, you will understand not just what happened in 2008, but how it was built, who built it, why the warnings were ignored, and what it tells us about every system of power that operates at that scale. Start at the beginning, not 2007, not 2001. Go back to 1933. After the Great Depression dismantled American banking and threw a quarter of the country out of work, Congress passed the Glass-Steagall Act. It was a simple law with a clear purpose. It separated commercial banks. The logic was equally simple. If you are gambling with house money, you cannot also be holding the house. That separation held for 66 years. In 1999 it was repealed. The law that replaced it, the Gramm-Leach-Bliley Act, allowed commercial banks and investment banks to merge. It was signed by President Clinton with the support of both parties. The men who lobbied hardest for that repeal included Robert Rubin, then Treasury Secretary, who left government shortly after and took a senior position at Citigroup, one of the primary beneficiaries of the deregulation he had championed. His first-year compensation at Citigroup exceeded $15 million. This is the backstory. This is the foundation on which everything else was built. The demolition of the legal wall between speculation and ordinary savings did not cause the crisis by itself, but it created the architecture in which the crisis became possible, and it created the incentive structure that made the crisis inevitable. Now understand what the financial industry built inside that architecture. In the late 1990s and accelerating into the 2000s, American banks began packaging mortgages into financial products called mortgage-backed securities. The basic idea was not new. You take 1,000 mortgages, bundle them together, and sell the bundle to investors as a bond. Investors receive the mortgage payments as income. Banks receive immediate cash and move the risk off their books. For this to work, you need a continuous supply of mortgages. And here is where the mechanism turned predatory. Because the banks originating the mortgages were no longer holding them, they no longer had a financial incentive to care whether the borrowers could actually repay. The risk was being packaged and sold before the ink dried. The originating bank made its profit on volume, write more loans, generate more product, sell more securities, collect more fees. Whether the loans performed was someone else's problem. Specifically, it was the problem of whoever ended up holding the security. This model is called originate and distribute. Its internal logic was a time bomb, and every major institution on Wall Street understood exactly what it was doing. Inside these mortgage-backed securities, the banks introduced a further layer of complexity. They sliced the bundles into tranches. The top tranche would get paid first and was considered safe. The bottom tranche would absorb losses first and was considered risky. Then they took the risky bottom tranches from multiple securities and bundled those together into a new product called a collateralized debt obligation, a CDO. Then they sliced that into tranches. Then, in some cases, they created synthetic CDOs, which were not backed by actual mortgages at all, but by bets on the performance of other CDOs. Financial instruments betting on financial instruments that were already 3 layers removed from the underlying asset. The complexity was not accidental, it was functional. It made the products impossible to evaluate independently. It created opacity where there should have been transparency. It gave the ratings agencies plausible cover to apply their models without understanding what they were rating. And it allowed the banks to tell investors they were buying something safe when the underlying mortgages were already deteriorating. Now here is the detail that makes this a documented crime rather than a market miscalculation. The ratings agencies, Moody's, Standard & Poor's, and Fitch, were paid by the banks whose products they were rating. This is the fundamental conflict of interest at the center of the entire structure. If a ratings agency gave a bank's CDO a low rating, the bank would take its business to a competitor agency. The agencies competed for business. The business came from giving high ratings. The entire independent verification layer that investors relied on was being paid to approve the products it was supposed to evaluate. Internal emails from ratings agency employees released during congressional investigations show analysts describing certain products as crap while their company awarded them AAA ratings. One employee wrote, and this is in the record, that a deal could be structured by cows and they would still rate it. These are not disgruntled junior analysts. These are the people responsible for the ratings. They knew. The mechanism was built on knowing and continuing anyway because the fees were too large to stop. Simultaneously, the banks themselves began betting against the very products they were selling to clients. Goldman Sachs is the most documented example. In 2006 and 2007, Goldman's mortgage department built a trading position that would profit if the housing market collapsed. They called it the Big Short internally. While they were constructing that short position, they continued selling mortgage-backed securities to clients, including pension funds, insurance companies, and foreign governments. In one series of transactions later investigated by the Senate Permanent Subcommittee on Investigations, the Senate investigation described this as a clear conflict of interest. Goldman paid $550 million to settle SEC charges. No Goldman executive was criminally charged. The fine was less than the profit Goldman made on its short positions during the same period. Now understand where the regulators were. The Federal Reserve had authority over bank holding companies. The Office of the Comptroller of the Currency regulated national banks. The Securities and Exchange Commission oversaw securities markets. The Office of Thrift Supervision regulated savings institutions. Each of these agencies had the legal authority to examine what the banks were doing and intervene. In 2004, the FBI issued an internal report warning that mortgage fraud was occurring at epidemic levels and predicted it would cause a crisis if not addressed. The report received no significant regulatory response. In 2005, Raghuram Rajan, then chief economist of the International Monetary Fund, presented a paper at a Federal Reserve conference attended by Alan Greenspan and Ben Bernanke. The paper argued that financial innovation had created hidden risks in the system that could cause a major crisis. The response from senior economists was dismissive. Larry Summers, former Treasury Secretary, called the analysis Luddite. Reagan was largely marginalized in the academic conversation. His paper was correct in nearly every specific. In 2006, the head of the Office of Thrift Supervision, John Reich, was warned by examiners that IndyMac, one of the largest mortgage lenders in the country, was operating with dangerous practices. Reich protected IndyMac for more aggressive examination. IndyMac failed in 2008 in one of the largest bank failures in American history. John Reich resigned and faced no criminal charges. Alan Greenspan, chairman of the Federal Reserve from 1987 to 2006, testified before Congress in 2008 that he had found a flaw in his ideology. Specifically, he had believed that banks would regulate their own risk-taking out of self-interest. He had not anticipated, he said, that executives would take risks that destroyed their own institutions. This was presented as a failure of theory, but the emails from inside the banks show that executives understood the risks and took them because their personal compensation was based on short-term performance. They would collect their bonuses before the collapse. The shareholders and the taxpayers would absorb the losses. Greenspan's ideological failure was real, but it operated inside a system where the incentives had been constructed to make the catastrophe personally profitable for the individuals executing it. Here is the plot twist, and it requires you to understand one specific number. The total value of mortgage-backed securities and related derivatives outstanding in 2007 was approximately $60 trillion. The entire United States GDP that year was approximately $14 trillion. The financial system had constructed a superstructure of bets and counterbets that was more than 4 times the size of the underlying economy. And a significant portion of those bets were connected through insurance contracts called credit default swaps to AIG. AIG was an insurance giant. Its financial products division, operating out of a small office in London with approximately 400 employees, had written credit default swaps on more than $500 billion of mortgage-backed securities and CDOs. This meant AIG had promised to pay out if those securities defaulted. AIG had collected the insurance premiums. AIG had not set aside capital reserves to cover those payouts because the regulatory framework for credit default swaps, which were not technically classified as insurance products, required no such reserves. When the housing market began to fall in 2007 and accelerated in 2008, the securities AIG had insured began to fail. AIG owed money it did not have. And AIG's counterparties, the institutions it owed, included Goldman Sachs, Deutsche Bank, Merrill Lynch, and Société Générale, among others. The federal government determined that AIG could not be allowed to fail. If AIG defaulted on its obligations, the losses would cascade through every major financial institution simultaneously. The entire system would collapse. Treasury Secretary Henry Paulson, former CEO of Goldman Sachs, and Federal Reserve President Timothy Geithner coordinated the rescue. The government gave AIG $182 billion in bailout funds. AIG used that money to pay its counterparties in full. 100 cents on the dollar, Goldman Sachs received $12.9 billion from AIG using government bailout money. This is documented in the Federal Reserve's own records, which were initially kept secret and only revealed after congressional pressure. At no point in the bailout negotiations was there a serious attempt to require the counterparties to accept partial payment, which would have been the standard outcome in a private bankruptcy. Geithner, who supervised the Federal Reserve Bank of New York during the negotiations, later testified that there was no legal mechanism to impose haircuts on the counterparties. Emails released during congressional investigations showed Fed officials were directed not to disclose the identities of AIG's counterparties to the public. The identities were kept hidden for months. The justification was market stability. The effect was that the beneficiaries of the government bailout were protected from public scrutiny while the bailout was occurring. Geithner became Treasury Secretary under President Obama in 2009. He supervised the broader bailout structure, including the Troubled Asset Relief Program TARP, which distributed $700 billion in government funds to financial institutions. After leaving government in 2013, he became president of Warburg Pincus, a private equity firm. His compensation there was not disclosed publicly, but private equity firm presidencies at that level typically compensate in the tens of millions. This pattern is not coincidence. It is a system. The people who move between government and the financial industry do not change their orientation when they change their offices. They carry their relationships, their assumptions, and their professional loyalties with them. The regulatory apparatus was not captured in a sudden moment. It was captured incrementally over decades by a revolving door that made the distinction between regulator and regulated increasingly technical. Now here is what happened to the people who had no role in any of this. Between 2007 and 2010, American household net worth declined by approximately $13 trillion. The declines were not distributed evenly. They were concentrated in the middle and working class, whose primary asset was home equity. The financial sector's primary assets were financial instruments, many of which were supported by government intervention. From 2007 to 2009, median household income fell by 4.8% adjusted for inflation. It did not recover to 2007 levels until 2016, a decade later. The people who lost income, who were underwater on mortgages they had been approved for by banks that no longer cared about repayment, who were laid off when consumer demand collapsed, spent a decade recovering from a crisis built on top of their financial lives without their knowledge or consent. In contrast, the 6 largest American banks in 2009, J.P. Morgan, Bank of America, Citigroup, Wells Fargo, Goldman Sachs, and Morgan Stanley, received a combined $160 billion in direct TARP funds. By 2010, all 6 had returned to profitability. Combined executive compensation at those institutions in 2010 was approximately $140 billion. The crisis was not a shared experience. It was a transfer. Risk and loss moved in one direction. Recovery and profit moved in another. The Department of Justice pursued exactly one senior executive for conduct related to the financial crisis. Kareem Sarageldin, a Credit Suisse trader, was convicted in 2013 of concealing losses in a mortgage bond portfolio. He served 2.5 years in federal prison. He was not a senior executive. He did not design the system. He hid losses on a relatively small scale within a single institution. The architects of the products, the executives who signed off on the strategies, the lobbyists who dismantled the regulations, the rating agency employees whose emails document deliberate fraud, the regulatory officials who were warned and did nothing, none of them were charged. None of them were convicted. The Department of Justice under Eric Holder pursued civil settlements rather than criminal prosecutions. Holder later argued that the criminal prosecution of major financial institutions posed a systemic risk because conviction could destabilize the broader financial system. This argument, which became known as the too big to jail doctrine, meant that institutional scale became a legal shield. The larger the crime, the less prosecutable the criminal. J.P. Morgan Chase paid $13 billion in settlements related to mortgage-backed securities fraud. It was the largest settlement in Department of Justice history. It was paid by shareholders, not executives. Jamie Dimon, CEO of J.P. Morgan, received a 74% pay raise the year the settlement was announced, bringing his compensation to approximately $20 million. The settlement did not include a criminal conviction. It included a statement of facts that described conduct the Justice Department called deception of investors. No individual was charged. Bank of America paid $16.65 billion in a related settlement. Again, no criminal charges for executives. These settlements, measured in billions, sound like accountability. They were priced into the cost of doing business. The banks made multiples of the settlement amounts from the conduct being settled. The fines were line items. The executives who directed the conduct were never personally at risk. What you have just heard is a system operating, not a series of unfortunate accidents, not a failure of individual judgment. A system with identifiable components, the deregulation that created the architecture, the incentive structures that made the fraud rational at every level, the complexity that created opacity, the ratings agency corruption that provided cover, the regulatory capture that neutralized oversight, the government rescue that socialized losses while privatizing gains, and the legal framework that converted prosecution-worthy conduct into civil settlements paid by shareholders. Every component was built by specific people making specific decisions. The decisions are documented. The people are named. The outcomes are measured in foreclosed homes, depleted retirement accounts, and a decade of stagnant wages for people who had no hand in constructing any of it. The financial system did not accidentally produce this outcome. It was optimized to produce it. The optimization was not done in secret. It was done in congressional lobbying offices, in regulatory comment periods, in executive compensation committees, in the career trajectories of people who spent half their professional lives in government and half in the industry that government was supposed to regulate. Here is what you should carry with you after this video ends. The reason none of this produced prison sentences is not that the evidence was insufficient. The evidence was abundant. Congressional investigators found it. Journalists found it. Academic researchers found it. The reason is that the legal system, the regulatory system, and the political system operate in a shared ecosystem with the financial system. They are not separate powers checking each other. They are interconnected institutions with overlapping personnel, shared assumptions about what constitutes acceptable conduct, and structural dependencies on the continued functioning of the entities they are supposed to regulate. This is not a conspiracy. Conspiracies require secrecy. This required no secrecy. The revolving door is public record. The lobbying expenditures are public record. The campaign contributions are public record. The settlement terms are public record. The only thing required to understand it is the willingness to follow the mechanism rather than accept the explanation. The 2008 financial crisis is not history. The institutions that built it are larger now than they were then. The regulatory frameworks reconstructed in its aftermath have been partially dismantled. The compensation structures that incentivize the conduct have not been fundamentally altered. The revolving door continues to rotate. The people who went through it continue to move between government and the industry, and the population that absorbed the cost continues to work inside a system designed not to serve them, but to extract from them with maximum efficiency and minimum legal exposure. $500 billion in settlements were paid. Not one architect of the system spent a night in a cell. That is not a failure of justice. That is justice operating as it was designed to operate when the people who design systems are the same people who own the outcomes. The question is not whether you knew this. The question is what you do with knowing it now. If this video revealed something that was not in your frame before, share it with someone who needs to understand how power actually works, not how it presents itself. Subscribe if you want to continue following these mechanisms, because this is not the last time we will follow the money to its actual destination. The verdict on 2008 is still being written, not in courtrooms, where it has largely been foreclosed, but in the choices of people who now understand what they are choosing inside of